Hi everyone, welcome to another lesson from Lesson Up Squad, and today you'll be learning all about budgets. So as I have communicated before, this time we'll be taking a new approach to learning. So basically what I want to do is help you understand the question with more exam techniques, how to read the question and how are you supposed to answer a question. And we'll be doing that based on cash budgets and projected income statement and some theory around it. The source I've used is paper 2 of 2020, which is the exemplary. So let us now look at the question we're going to be doing today. One of the first most important thing when you look at a question is to make sure that you take notice of the year end. In an exam paper, each question has its own year end, so don't confuse yourself with the year end, and that can cost you unnecessary marks. So what you would like to do is, and what I like to do is draw a timeline. I physically draw a timeline before I even start, and I've always highlight my year end. So this says the year end is 31st October 2019, which means the year end is from the 1st of November 2018 to the 31st of October 2019. So draw that timeline. And like I've said today, we'll be doing budgeting. So what is a budget? Budgets are future cost and income that you are budgeting. It's a prediction what you think you will earn and what you think you will expense. So write this down. It's a future prediction. It's a planning that you do. You're not sure 100%, but you do have a good idea of the kind of expenses you will incur. On the other hand, a projected income statement is an income statement that you think will happen, right? So this is also a lot like budget. The only difference is you can see budgets are usually cash. A cash budget only takes into account cash item. A projected income statement, on the other hand, will only take into account items you would take into account in your income statement. So a projected income statement is also budgeted, right? But it is not only cash. It's just like your income statement with everything. Whereas a cash budget, on the other hand, has only cash item and it is also projected. It's also budgeted. So in the exam, they could easily use the term budgets or projected. It means the same thing. It means things you are planning to happen. They have not yet happened. Whereas on the other hand, when you usually prepare an income statement, it's already expenses that you've incurred. Okay, so here you can see the question says indicate amounts in the appropriate blocks for the cash budget and the projected income statement for 3 months ending 31st Jan. So you would see that they're asking you to do two things. So always make sure you understand. You can see here they said a cash budget and a projected income statement for 3 months. Take 30 seconds of your time and make sure you know the difference between the two. Cash budget, only cash items, future expenses and income that you are going to spend. Projected income statement is everything that goes into the income statement, not necessarily just cash, but also future items. So these are all income and expenses you haven't yet spent. That's both for budget and projected income statement. Okay, so I'm going to read through each of these and we'll work through each of these questions. So let us now look at the question that you are going to be dealing with. One main tip to always remember when you're preparing a budget or a projected income statement, it will always be prepared on a monthly basis. That is because you would like to see as a business where your income and expenses are coming and going for each month, and it is not to prepare for the financial statement for the year end for your shareholders. This is more for your internal purposes. Therefore you want to see a monthly amount and not the full year amount. So always prepare these on a monthly basis. Also remember, here we had to prepare a cash budget. Cash, it has to be anytime you spend money or receive cash money, that's when it would go into your cash budgets. People prepare the cash budgets to know how much money physically they need to have in the business to run the business. Projected income statement, on the other hand, is an accounting entry. So it's not necessarily cash, it's only what is accounted for during the year. Also be careful, when preparing a cash budget, it takes into account anything that you're going to be spending for that period of time. So in our case, for the 3 months ending 31st January. But for an income statement, it means anything that will be only for this year for 3 months, right? So you will have prepaid expenses and accrual expenses. These do not go entirely into your income statement. These will go into your cash budget, but they won't fully go into your income statement. We'll look at an example now, but very important to remember, a cash budget is not prepared just for the financial year. It is prepared for the period you are in and relates to the actual money that you have spent or received, whereas a projected income statement is just like an accounting normal income statement, except it is divided into months. All right, let us now look at both of the cash budget and income statement side by side. The first entry is a printer costing 40,800 will be bought for cash on 30th November 2019. Depreciation will be 680 per month. So you've got a printer that you actually pay 40,800 for in November. You've actually paid that money. Therefore, that amount will be part of your cash budget. You need that money to be able to purchase that printer. But in your accounting, you do not record the cost of the asset. That goes on your balance sheet. In your income statement, you just have the depreciation. Therefore, for December and Jan, you would have 680 rands worth of depreciation for each month. That is your accounting entry for the 2 months. Then on 1st January 2020, 48,000 will be paid for 12-month insurance contract. You can see this is a prepaid adjustment. If you'd like to learn more about prepaid, I'll link the video just here so that you can be able to see how to work out prepaid. But for now, we'll just look at this. 48,000 is paid for the whole year. In your cash budget, you're actually going to pay 48,000. You need that money, irrespective of the fact that it is only for your next financial year. You are paying it today, so you will need to have access to the funds today. You will have 48,000 paid in Jan in your cash budget. However, for insurance purposes, you only need to record your insurance for the 1 month that you will be paying, which is at the beginning of Jan. Therefore, you would record it just for Jan. Remember, an income statement tells you a story just for 1 year. That would be 48,000 divided by 12 to give you your 4,000 rand that you need to record in your income statement. Number 3, a loan of 100,000 will be received from Viva Bank on 31st December 2019. When I see such a long adjustment, a 3-liner, I do one part at a time so that it doesn't overwhelm me and it makes you feel confident. So you'll be receiving money from a bank on the 31st of December. So that is, you put this as a positive sign because you're going to be receiving this money, which is a good thing. You're now receiving this money. What is the impact on your income statement? There's no impact on your income statement. Think about your journal entries. When you receive a loan, you would say debit bank, credit loan. Both are on your balance sheet. Nothing goes on your income statement. Thereafter, it says this will be repaid in equal installments over 20 months. Okay, so now we're paying the loan. And what are your journal entries for paying a loan? Credit bank, debit your loan. You're reducing your loan, crediting your bank. You've now paid your loan in equal installment, which is 100,000 divided by the 20 months. You've now paid your loan. What is your income statement? No effect, because the journal entries guided us to think there was no effect. Then there's interest, right? So here it says interest is at 12% per annum and is paid monthly and is not capitalized. So when something is not capitalized, it means your journal entries would be debit interest, credit bank. Because it's not capitalized, it doesn't go to your loan account. It goes directly into your income statement. This is important to understand because you could identify that it goes into your income statement, so you will have an effect on your income statement. Whereas if interest was capitalized, your journal entries would be credit loan, debit interest, right? And it wouldn't go through your bank account, so it won't be cash, right? It won't be cash, therefore it won't then go into your cash budget. So that was very important to understand what your entries are for your capitalized and not capitalized. So you would see, because you are paying this, you are paying this interest, it would go into your cash budget, 1,000 rand, and it would also have an accounting entry of 1,000 rand. The most important thing to remember is not to put everything into the income statement and cash budget because you're unsure where to put it, because this will lead to you getting negatively marked and you're going to lose marks that you've actually earned. So don't do that. Think of it logically. Think about what goes in a cash budget, only cash item. What goes into a projected income statement items that you would normally put. This is just per month basis, nothing else. Okay, let us now look at another question. This is a scenario to assist you to answer theory questions and how else you're supposed to be thinking when it comes to theory questions. Many of you say that theory questions are always very confusing. You actually struggle more with theory than the actual practical questions, and it's normal. That is because sometimes you're not thought about how it works in real life. So now I'm going to try and implement a few things that will assist you in thinking how you're supposed to be thinking and be able to answer the question. So here we have a scenario regarding our projected income statement for the month. It's based on the same question we had before. Let us now start looking at the questions. So, in this question it says the office workers are unhappy with the increase that Tembi gave them on the 1st of October. Explain what should she say to them and provide 2 points, code figures or a calculation. So always remember when you're doing a theory question, even if they don't tell you to code figures or calculation, it is for your benefit that you do that. Rather put the figures or the calculation and get a bonus mark for it or get an extra mark for it than not putting anything and losing a mark. So in this question, you always determine whether this is a good thing or a bad thing. Now we know the office workers are unhappy with the increase Tembi gave them. What should she tell them? Should she agree to them or should she not agree to them? So that's the first thing you need to establish. Was the increase given correct, right? So you always look at how much increase was given to decide whether employees should be unhappy or not. So you know how to support your argument. In this case, the increase given was quite substantial. To get the increase, you take the new salary given minus the old salary divided by the old salary. That should give you the percentage of increase that was given. Now you've received that percentage. That percentage is 20%, and that is a lot of amount, right? Also, one thing, when you're looking at an income statement like this, always remember to look at actual amounts and not projected. Remember, the employees are unhappy because of the actual amount given to them, not because what you said you were going to give it to them. You always look at the actual because that's what's given to them, and they're unhappy because that's what was given to them. Okay, so in real life, if you've got a family member working in corporate, they would tell you that anything above inflation is absolutely great, right? So receiving any salary above inflation is a positive and a good sign, and a business is doing well if they'll be able to pay anything about inflation. Currently, the inflation rate in South Africa goes about 4%, 5%. You can always Google that before you go into the exam and compare that. So they receive 20% increase versus the inflation of 5%. That is excellent to have received. So Tembi's employees have no right to actually be unhappy. And that's how you put yourself down in the exam paper. Also, you would see that the business did not achieve its target. Even though the business did not achieve its target, it still helped the employees by giving them the increase. And that is a good thing if the business is not achieving what it was supposed to, but yet they got an increase. That is a good thing. You would also see in the real world, there is always mandatory to disclose directors' remuneration, and that is for the purpose that the shareholders want to know that the directors are not earning all the money, whereas the employees are earning nothing. So directors' salaries are always disclosed in the financial statement. In this case, we could see that the director's salary had decreased. Hence, that would actually mean that the director took a pay cut so that the other employees could be incentivized and compensated. So that means the increase Tembi has actually given them has been quite good. There were also other things that Tembi had increased in, which was training. So the best way to look at this is to go from line to line and see where you have increased, where you have decreased, and how you can actually take that increase or decrease and justify it to your question. Okay, let's look at another theory question. Tembi pays her son Jacob to deliver and install carpets for customers. She budgets 280 per meter for this. Comment on the control of this expense. Okay, so one thing you need to remember is they're giving you detail. You see here they tell you Tembi pays her son Jacob. So obviously when you're paying somebody you know, it can be that you're biased, right? So you're paying them more than what they should be getting paid. They might be getting paid earlier. So these are ethics questions they might ask you in the exam. Although here this question doesn't ask you about the ethical part of it, but if they do ask you about the ethical part of it, you can say that when somebody that you know is getting paid, so it could be your friend, your son, your child, your parent, anybody, you are biased to pay them more than what they should have been paid. And you'll actually see with this example, because here you see she budgets 280 per meter for this. So you can see this is a variable cost. So basically every meter that they sell, he would be paid. And you can also see that the more that you sell, the more he will need to be paid, because he is paid per meter and not a fixed cost. So let us look at how much was paid to him. If you see, in September you projected 14,000 and you actually paid him 14,000. In October you paid him 16,800, but you projected 14,000. So at first glance, October looks like he wasn't paid correctly, but let us actually remember that he was paid per meter, right? So selling price, she had sold, in actual she sold 3,800, but in September she projected 4,900. So that means she said if she was going to sell him 4,900, she would have paid him 14,000. But she actually only sold 3,800 and then she paid him 14,000, which means she paid him more than what he should have been paid for. Also, you would see that in October she projected 5,000 meters and she would still pay him 14,000, and the actual she projected 6,000, the actual that she sold was 6,000 and then she paid him 16,800, and that seems fine with the meters that she sold, and were more than she projected. Therefore she had to pay him more because she's paying him per meter. So remember, just because September looks like they were paid what actually she was projected doesn't mean it was correct, right? Just because she projected 14,000 doesn't mean she needs to pay him 14,000. We have to now look at the sale, and that is where you have to talk about how she's paid him more in September even though she sold less, versus October where she paid him more but she did sell more, so it was correct. Let's look at another question. A new competitor commenced trading in the area on the 1st September. Provide figures to illustrate the impact on sales in September. Explain 3 decisions that Tembe took in October to respond to the new competitor. Quote figures or calculations. Once again, this question is in 2 parts. Provide figures to illustrate the impact on sales in September. So we know now that a competitor started and it has affected the September sale. So even before you look at the numbers, what do you think is the most common thing that happens if a competitor starts? What happens is your sale would go down. That is one of the most common effects of a competitor starting a business right near you. Right? So here we have to attend to the first part. It tells us specifically only to look at September. So what happens in September? You would see that your selling price in September was 100 and actual was 100. Your cost price was 60, your actual was 60. Your cash sale was 400,000, but your actual sale was 310,000. Your credit sale was 90,000, but your actual credit sale was 70,000. So your total sales was 490,000 projected, whereas you only made 380,000. That's almost 100,000 Rand less sale that you actually projected, and that is actually quite bad for the business. A business can be off from their budget, but they cannot be significantly off from their budget. There has to be good reason for being significantly off, and that is, for example, a competitor in this case. And therefore you will see the next question, and the next month you will see Tembe takes decisions to help his business. But you can see the impact on his sale was that his sale decreased. What you can do is show the percentage it decreased. So you would take the actual sales 380,000 minus 490,000 over 490,000 to explain the percentage of drop in sales. Now to do the second part, it says 3 decisions that Tembe took in October to respond to the new competitor. Let's start from the top. You'll see that in October your price was 100 Rand that was projected, but what did you sell it for? 88 Rand. That is a new trick, right? So Tembe wants to make sure that he is selling for a lower price than his competitor, because that's the only way he'll retain and attract new customers. So you've got 88 Rand, that's what he actually sold for. You'll see his cash sale projected was 400,000 and his actual cash sales was 132,000. He projected 100,000 credit sale, but he sold 396 Rand on credit, which is a good thing. That means he's actually promoting more credit sales to attract and retain more customers. Excellent thing to do for business. If you do have a new competitor, people are usually attracted to credit. So that is a good technique. We would also then look at expenses. You would now see that, for example, your salesperson. So it's very important to remember salesperson are the people that sell your product. Usually it is a bad idea to have a fixed salary for your salesperson because they have no incentive to work for. Whereas a commission-based salary helps your salesperson to drive up your sales. The more they sell, the more money they get. Right? So therefore, you need to make sure that you can see differences like this, and that is only based on the actual line, right? We know that the director's fees went down. It had nothing to do with the competitor. We know the office workers went up. It had nothing to do with the competitor. The salary of the salesperson and the commission of the salesperson, you can see what happened. The salesperson's salary structure was changed. He sold actually more. Although we're paying him more salary, he actually did more work to sell your products. You will see advertising, there was no change. Packing material, there was no change. Delivery and installation carpet was no change. You would also see you've trained your staff more. That can possibly have an impact on increasing sale. Maybe you got staff that is better able to answer your customers' questions, which means that customers retain more. Therefore, these are all good things that would have helped to increase your sale. So you will see today we took a new approach to the question by discussing the question more, and I think this will be very helpful. The points that I've put out for discussion is to show you how you're supposed to think in the exam. So take these techniques, make notes with the lesson you have today, and see how you can apply it to all your questions throughout. Thank you so much for watching, guys. But today we've actually addressed how to look at required that are multiple. Always remember that if you're preparing budgets and projections, they should be monthly. Only include expenses for 3 months. This is something you need to be careful about. They asked you to do the question only for 3 months, but that is for the income statement. Remember, cash budget is all that you spend, irrespective of whether it's for a year, 2 years, 5 years. If it's a cash budget, money that you're going to spend in the 3 months, that's what you put in, unlike your accounting statement. And we looked at how to answer theory questions relating to budgets. That's all for today, guys. Thank you so much for watching. Hope you guys have learned. If you still have any questions, please feel free to drop me a mail, subscribe to our YouTube channel, follow us on Instagram, feel free to ask questions in the WhatsApp group, and most importantly, please share this initiative with all your family and friends so that everybody can benefit. Thank you once again so much for listening. Until next time, bye-bye.